Between August of 2000 and April of 2001, the stock market dropped by around 25%, and this happened at the same time as bond yields in the United States were falling. This is what you call a stocks down, yields down environment, and it's typical of economic recessions. In fact, in April of 2001, a recession began in the United States, dragging the stock market down for another 40% decline. When we fast forward to the global financial crisis, this initial leg down in stocks was also accompanied by a significant decline in U.S. interest rates. Again, the same type of recessionary behavior that led straight into the 2008 recession. Now, fast forward to 2024, and we've seen two pretty substantial declines in the stock market, both of which have been accompanied by falling U.S. yields. This type of stocks down, yields down environment is something that we haven't seen since March of 2020, yet another recessionary environment. So many investors are jumping to conclusions today that the market is beginning to price in an economic downturn in the US, and that both stocks and bond yields have a lot more downside from here. But as I'm going to show you in this video, things are a lot more complicated than that. Now, yes, bond yields are falling in a similar fashion to the way they were heading into the 2001, 2007, and 2020 recessions, but there's been plenty of times where US bond yields have been falling without the US economy necessarily being in a recession. Today, bond yields have been falling quite aggressively, but so have oil prices, and so has the US dollar. These are three of the most powerful financial market forces, and all of them are heading into the same direction. This is an extremely rare environment, and it has absolutely massive implications for markets looking forward, as I'm going to show you in this video. But first, don't miss the 30% discount that we're doing on our service. We don't do this type of discount very often. This would give you access to all of our trade alerts to get in or get out of the trades that we're making. So far in 2024, we've closed 65 trades. 2/3 of these were profitable with an average profit of 16%. Our average loss was just 3.5%. We can proudly say that anybody who's been following our trades consistently has been making much more than the cost of our subscription. And if you use this discount, that would be for a ridiculously cheap price. So make sure to click the link down below to get access to the discount. We're ending it on the day of the Fed meeting, so don't miss your chance. Believe it or not, this type of environment where the dollar is moving down, oil is moving down, and yields are moving down has only occurred briefly 9 times going back to 1980. All of those instances are highlighted right here, and each of them were a very powerful signal for the stock market. Now, let's quickly take a look at what each of these variables should mean for the stock market. A falling dollar, falling oil, and falling bond yield. Are each of these a good or bad thing for the market? Let's start with the influence of a US dollar weakening on the stock market. This chart shows us where S&P 500 company revenues come from. About 70% of the revenue comes from the United States, so that's revenue priced in dollars, but about a third of S&P 500 revenues come from abroad. And so this big chunk of revenue is actually not priced in dollars, but in other foreign currencies. So when we see the US dollar weakening, it actually makes S&P 500 revenues coming from abroad look bigger in dollar terms. So when the dollar is weakening, it actually helps push up S&P 500 company earnings. This is almost a mechanical rule, and that's why almost every single time that we see a big weakening of the US dollar, that's typically associated with a big move up in US stocks. Okay, so great. The US dollar weakening tends to have a positive impact on the market. But what about weakening oil prices? Well, oil prices are actually a major cost for many businesses. Oil often provides the energy to manufacture, process, and transport products. So if oil prices are going down, it actually tends to lower the cost for businesses to operate. Lower costs means that profit margins increase, which should be a good thing for S&P 500 companies, of course. Crude oil prices also, of course, have an impact on gasoline prices at gas pumps. You can see the two pretty much have a mirror image of one another. If you drive a car to get to work every day, you'll know that lower gas prices will help out a little bit when it comes to budgeting. So not only do lower oil prices increase profit margins, but they can lead to higher levels of consumer spending, and so potentially contributing to increased S&P 500 revenue. Okay, so a weak dollar and falling oil should theoretically be good things for S&P 500 revenues and profit margins. But how on earth do lower bond yields impact the stock market? Lower bond yields don't tend to have much impact on S&P 500 earnings, except maybe companies that are overly indebted. They do impact, however, something called the price to earnings. commonly known as the PE ratio. This is essentially the valuation of stocks, how expensive they are. This chart shows us the yearly changes in the S&P 500's PE ratio. It varies a lot over time. When this line is very elevated, it means the stock market is getting more expensive, and when this line is very low, it means the stock market is getting cheaper. Now look at what happens when I add bond yields on top. We can see the two are incredibly closely correlated. In fact, the more recent rise in market valuations we've seen between 2023 and 2024 has been a direct result of falling bond yields. So in theory, the dollar falling is good for the market, oil prices falling are good for the market, and bond yields falling are good for the market. So let's take a look at whether that's been true throughout history. These are all of the instances going back to 1982 where we've seen this type of environment with the dollar, oil, and yields falling. Pretty much every single one of these episodes saw the market move up during this environment and in the months following this environment. So indeed, both in theory and practice, the environment that we're witnessing today is pretty constructive for stocks. Now, August and September are seasonally weak periods, which explains the recent volatility that we've seen and could potentially continue right up until October. But overall, we have been using this volatility as an opportunity to increase our exposure to the market, especially in more defensive areas like healthcare and utility stocks that have been performing incredibly well during this period. Again, if you're interested in following our trades, our research, our strategy, make sure to take advantage of the discount that we're doing right now. It won't last long. We also have a big announcement. We're doing a branding change. We're changing our name from Game of Trades to Bravos Research. We're going to be making the change on the 30th of September, so please make a mental note of that if you want to continue following our work.